If you've seen my recent videos on discount bonds, this one picks up right where we left off. I honestly didn't think this would be that exciting until I saw what BMO had done behind the scenes. And that's when I thought, okay, that's actually really smart. BMO has quietly made some changes to its asset allocation ETFs that could help make them more tax efficient, all without adding much risk or extra work on your part. For taxable investors, that's about as close as you can get to a free lunch, aside from diversification. These changes apply to 3 BMO ETFs, the BMO Conservative ETF, ZCON, the BMO Balanced ETF, ZBAL, and the BMO Growth ETF, ZGRO. And just a quick note up front, these changes only affect the bond side of your portfolio. So if you're only invested in an all-equity ETF, this video isn't for you. But if you're a taxable investor holding bonds inside any all-in-one ETF, that's where things get interesting. Now, before we get into the changes, let's discuss the elephant in the room. Compared to iShares and Vanguard, BMO's asset allocation ETFs are still a smaller player. ZCON has under 100 million in assets, ZBAL is under 500 million, and ZGRO is around 600 million. Meanwhile, the iShares and Vanguard counterparts are in the multi-billions. For years, picking between these ETF providers was basically a coin flip. Same broad idea, similar exposures, tiny differences. And honestly, that used to be fair, but I don't think it is anymore. Back in December 2025, Kevin Prinz from BMO ETFs, the original brain behind ZDB, mentioned something almost in passing that immediately caught my attention. BMO had removed ZAG, their traditional aggregate bond index ETF, from ZCON, ZBAL, and ZGRO, and replaced it with ZDB, the BMO Discount Bond Index ETF. This wasn't a cosmetic tweak. It was a deliberate, tax-smart decision. And if you watched my last 2 videos, you know why discount bonds matter. They earn more of the return as capital gains and less as fully taxable interest. Exactly what you want in a non-registered account. And based on real after-tax data for a top-rate Ontario taxpayer, ZDB outperforms ZAG by about 0.26% per year after tax over the past decade. Similar before-tax return, similar volatility, better after-tax efficiency historically. And here's where that advantage flows through the asset allocation ETFs. ZCON has a 42% allocation to ZDB. ZBAL has 28%, and ZGRO has 14%. So just from this one swap, the expected after-tax benefit is roughly 0.11% for ZCON, 0.07% for ZBAL, and 0.04% for ZGRO. These numbers might look small, but in the world of asset allocation ETFs, where the offerings across product providers are so similar, this is a meaningful edge. And you get it without much more risk, complexity, or lifting a finger. No extra work, no extra decisions, just a tax-friendly setup. At this point, I was already impressed. Then I looked at the US bond exposure, and this is where it gets even more interesting. All 3 of BMO's asset allocation ETFs hold ZUAG.F, which tracks the Bloomberg US Aggregate Bond Index hedged to Canadian dollars. On the surface, ZUAG.F looks like Vanguard's VBU, which tracks the same index. At first I assumed same index, same story, nothing special. But I was way off. ZUAG.F holds the underlying US bonds directly, while VBU gains exposure through a US listed ETF. Now, most US bonds pay qualified interest income, which isn't subject to US withholding tax. And roughly 90 to 95% of the bonds in the index typically qualify. And that aligns with the data. VBU's withholding tax rate in 2024 was under 2%, not the 15% investors often worry about. Interestingly, ZUAG.F had no withholding taxes applied to its bond interest that year. At first I thought this might be the advantage, but Matt Montemurro from BMO clarified that this outcome isn't the result of an intentional effort to avoid non-QII bonds. A small subset of bonds, typically unique government structures or certain municipal issues, don't pay QII, but they also tend to be less liquid. And because BMO uses liquidity screens as part of its sampling process, these bonds are often excluded. So the limited exposure to non-QII bonds is largely a byproduct of the replication approach, not a tax strategy. The real story, however, is coupon management. ZUAG.F tracks over 13,000 individual US bonds, and BMO uses a sampling strategy. That means they don't need to hold every bond in the index, and they actively take full advantage of this flexibility, favoring lower coupon bonds whenever possible. Lower coupons generate less taxable interest and more of the returning capital gains, which is exactly what taxable investors want. By contrast, Vanguard's VBU simply holds a US-listed ETF, BND. Because it doesn't hold the underlying bonds directly, it has no ability to pick lower coupon bonds or optimize for tax efficiency. It's fully tied to whatever BND holds. In other words, BMO's direct bond structure gives them the flexibility to manage coupon exposure for tax purposes, while VBU cannot. As of December 31st, 2025, ZUAG.F's average coupon was about 2.8%, compared with roughly 3.8% for VBU. Yet despite the very different coupon profiles, both portfolios had the same average yield to maturity of 4.3%, which represents the expected return for the bond portfolio. That 1 percentage point coupon difference matters in a taxable account. Lower coupons equals less taxable interest today and more of the return in the form of capital gains. Basically, BMO has built a US discount bond strategy hiding in plain sight. BMO has paired a Canadian discount bond ETF with a stealth US discount bond strategy, all inside simple one-ticket asset allocation ETFs. No extra work for investors, no extra decisions, just a tax-friendly setup. When BMO walked me through this, I'll admit, it's the kind of thing that makes fixed income nerds pretty excited. If you already hold iShares or Vanguard asset allocation ETFs in a taxable account at a gain, don't rush to switch. But for new investors or new money, the choice between product providers may have gotten a bit simpler. The best part? BMO did it thoughtfully, behind the scenes, and focused squarely on tax efficiency. Sometimes the best upgrades don't make the headlines. They're the ones you barely notice at first, but that quietly compound into something meaningful over time. For taxable investors, that's the kind of improvement that can really make a difference. Thanks so much for watching. I'm Justin Bender, and in my next video, we'll take a closer look at BMO's all-equity ETF, ZEQT, the underdog compared to XEQT and VEQT, to see whether it deserves a second look. And if you found this helpful, feel free to like the video and subscribe so you don't miss that one. And I'll see you soon.